Most South African retirees are overpaying tax, not because they've made bad decisions, but because retirement changes the tax rules completely. The planning that worked while you were earning a salary often doesn't translate once you stop working. Suddenly, you're dealing with more complexity. Minimum living annuity drawdowns, tax on withdrawals from discretionary investments, including capital gains tax on both local and offshore assets, dividends tax, and tax on interest earned, all while trying to figure out where and when to take income from your investments. And the real challenge isn't how much you have, it's how much of your hard earned money do you actually keep. Today, I'm joined by two of my colleagues, Cam Sondlo and George King, and we're going to walk you through exactly how this plays out in real life. So, Cam, let's start by laying the foundation for today's discussion. Tell us a bit more about the case study that we're looking at today.
Let's introduce you to Thabo and Maria, a South African retirement story. They both had successful corporate careers and retired 2 years ago. At the age of 67, they've done almost everything right. No debt, paid off home, solid pension income, rental income, and a well-diversified investment portfolio. They live comfortably and don't overspend. By all accounts, they are good retirees. And yet, despite doing everything right, they were losing hundreds of thousands of rand over time to avoidable tax. Not because their plan was bad, but because it wasn't coordinated.
And that's the key theme that we're going to explore in today's masterclass. They didn't need a total revamp. They needed smarter withdrawal and tax strategies. Over the years, we've helped thousands of retirees like Thabo and Maria retire with confidence and clarity. And what we've learned is this. It's really one big move that reduces tax in retirement. It's usually a series of small, well-timed decisions made consistently and can have a dramatic impact over the long run. Before we continue, a quick reminder. This video is for educational purposes only and it doesn't constitute personal financial advice. Always speak to a qualified financial planner before making any big financial decisions. So George, before we jump into the numbers, let's first frame the tools. Most retirees know some of these tools, but very few use them altogether. So that's where the magic happens.
So, the first tool we're going to look at is asset allocation. This isn't about what you invest in, it's about which investments lives in which account. Secondly, tax efficient withdrawal sequencing. Not all income is taxed the same. Where you draw your income from first matters more than most people realize. Thirdly, capital gains management. Selling the wrong assets at the wrong time can trigger unnecessary capital gains tax. Number 4, tax loss harvesting. Market volatility isn't always bad. Used correctly, losses can reduce future taxes. Number 5, charitable giving done correctly. Many retirees give generously, but get almost no tax benefit from it. With the right structure and timing, giving can be both impactful and tax efficient. Number 6, retirement annuity and preservation planning. Even after retirement, these vehicles still matter for tax smoothing and estate efficiency. And finally, efficiently using vehicles such as tax wrappers, which could be sinking funds or endowments, and Section 10C of the Income Tax Act disallowed contributions. Depending on your circumstances, each of these tools offers different tax advantages, which can meaningfully reduce your overall tax obligation.
So guys, as we just discussed, when it comes to proper retirement tax planning, the goal isn't to pay the least tax only this year. The goal is to pay the least amount of tax over your lifetime, while maintaining flexibility and control. Individually, these tools help, but used together, they change everything. So Cam, coming back to our example, let's have a look at how Thabo and Maria's situation actually looked.
Let's start with Thabo's income sources. So he has a living annuity income of 600,000 per year. The net rental income from a Johannesburg townhouse of 240,000 per year. And when you look at his discretionary investment income, he withdraws approximately 150,000 per year, but earns close to 700,000 in interest, all of which is taxable. So it brings the total taxable income to a little over 1.5 million. And then we have a look at Maria's income sources. Living annuity income of 500,000 per year,
net rental income from a Pretoria house of 360,000 per year. So look at her discretionary investment income. She withdraws approximately 100,000 per year, but is earning close to 500,000 in interest, all of which is taxable. This brings her total taxable income to about 1.3 million. So now we have a look at their expenses. Their monthly core expenses were around 60,000 per month, and they were comfortably meeting their needs.
So, George, based on your initial impressions, looking at Thabo and Maria's situation, what are some of the red flags that stand out from a tax planning and investment structure point of view?
Well, Hardi, to begin with, their primary source of monthly income was their living annuities, which meant the money they've been receiving was taxed at their marginal tax rates. Additionally, since their bonds and cash investments were held in their own names, they were responsible for marginal tax on all the interest earned within their discretionary portfolios, even though they were only drawing a small portion of it. Nothing reckless, just inefficient. If we look at their tax reality based on the 2025 SARF income tax tables, we see the following. Thabo has a marginal tax rate of 41%, with an average annual loss to taxes sitting at 32.5%. His annual tax bill is approximately 490,000 Rand. That left him with an annual gross income of plus minus 990,000 Rand and an after tax income of plus minus 500,000 Rand. Despite this, he was actually only using 150,000 Rand from his investment portfolio, yet paying full tax on the 700,000 Rand interest earned. On Maria's side, she has a marginal tax rate of 41%, with an average annual loss to taxes sitting at 31.4%. Her annual tax bill is approximately 416,000 Rand. That left her with a gross income of plus minus 960,000 Rand and after tax income of approximately 540,000 Rand. Again, she was only withdrawing 100,000 Rand from her investments, but paying tax on the entire interest amount earned.
So, before we dive deeper into the strategies that we use to actually reduce the overall tax bill, I'd like to ask you a favor. We have agreed to impact as many South African retirees as we possibly can, and you can help make this happen by hitting the like button and subscribing to the Family Wealth YouTube channel. We focus on providing quality retirement and financial planning content for South African retirees. We'd also love to hear your thoughts on the current retirement tax system in South Africa. So feel free to leave a comment in the comment section below. So Cam, the goal for the 2026 tax year was to reposition their portfolios and lower their taxable income and allow for a much more optimized strategy. So chat us through it.
So step 1, asset location. Both Thabo and Maria held significant portions of their discretionary investment portfolios in bonds and cash, invested in their own names. Now, the problem with that structure was simple but costly. All interest earned above the annual interest exemption was fully taxable in their hands, whether they withdrew the income or not. So even though Thabo was only withdrawing 150,000 per year from his portfolio and Maria only 100,000, they were paying tax on hundreds of thousands of rands in interest they didn't actually need. At the same time, the growth portion of their portfolios, local and offshore equities, sat largely inside their living annuities, where growth is tax deferred. In other words, highly taxed, interest-heavy assets sat in taxable accounts. And then tax-efficient growth assets sat in retirement vehicles. Nothing unusual, but from a tax perspective, it was inefficient.
In their situation, without altering their overall risk profile or long-term investment strategy, we did the following. Reduced the exposure to bonds and cash inside their discretionary portfolios and increased growth-oriented assets in those accounts instead. And we shifted more interest-generating assets into their living annuities where the interest is not taxed annually. The outcome was immediate. Less taxable interest each year, lower marginal taxes, and more control over when tax is triggered. Most importantly, this created space. So George, why don't you take us through the next step?
The next step is tax efficient withdrawal sequencing. Once we had fixed where income was being generated, the next step was deciding where income should come from first. Instead of continuing to withdraw the bulk of their income from the respective living annuities, we deliberately changed the order of withdrawals. We recommended that Thabo and Maria withdraw a small portion but intentional portion of their income from their tax-free savings accounts. then supplemented their income from their discretionary investment portfolios, where withdrawals could benefit from the lower effective tax rates on capital gains. By doing this, we were able to reduce the amount they actually needed to withdraw from their living annuities, which in turn lowered the portion of income tax at full marginal tax rates.
So it's important to remember that withdrawals from living annuities are taxed as ordinary income, while withdrawals from tax-free savings accounts are still tax-free. And capital gains are taxed at a much lower effective rate than normal marginal tax rates. So the objective wasn't to avoid tax. It was to pay the right type of tax at the right time. This single change immediately improved their tax position and gave us far more flexibility for the next steps in this retirement plan. Step 3 is capital gains management. During one of our consultations, Thabo shared that he was struggling with the tenants in his Joburg townhouse. Rent was coming in late, maintenance issues was piling up, and he was simply tired of the ongoing responsibility of managing the property. He wanted to sell, and emotionally, that decision made complete sense. The challenge, however, was timing. Thabo owned the property for a long time, and the capital gains exceeded 1.5 million rand. At the same time, the taxable income for the 2025 tax year was already high. Selling the property immediately would have pushed a large capital gain into an already high income year, resulting in a significantly higher CGT tax bill than what's necessary. So instead of rushing the sale, we recommended a short pause. But postponing the sale by a few months, Thabo could do the following. He realized the capital gains in the following tax year when the overall taxable income would be materially lower and therefore pay less capital gains tax on the exact same transaction. Nothing about the asset changed. Nothing about the decision to sell changed. The only thing was timing, and this single adjustment made a meaningful difference to his after-tax outcome. That's the power of intentional capital gains management. Not avoiding tax, but choosing when to trigger it. Step 4 is tax loss harvesting. So, Cam, market volatility isn't always a bad thing. Used correctly, realized losses can be used strategically to offset gains and reduce future tax bills.
Yes, Hardi. In Maria's case, this became particularly relevant. During her working years, Maria had received shares through a share incentive scheme at the company where she was employed, a listed company. At the time, the shares had meaningful value, but over the years, the company struggled and the share price declined sharply. By the time we reviewed her portfolio, the shares were worth less than half of what they were valued at the time she acquired them. Rather than holding on in the hope of a recovery, we made a deliberate decision. By selling the shares and realizing the capital loss, Maria was able to offset capital gains elsewhere in her portfolio, reduce the capital gains triggered by other asset sales, improve her overall after-tax outcome.
But there was an additional benefit. From an asset allocation point of view and from a risk management perspective, those shares represented a concentrated position in a single sector and a single company. By exiting her position, we were able to reduce unnecessary concentration risk and improve diversification across her broader portfolio. And at the same time, we aligned her investments more closely with her long-term retirement strategy. So this wasn't just a tax decision. It was a tax decision and an investment decision working together, which is exactly how effective retirement planning should work. Step 5 is charitable giving done correctly. So George, over the past couple of years, we've seen so many retirees that give generously, but receive very little to no tax benefit. But with the right structuring and timing, charitable giving can be both meaningful and tax efficient. And in Thabo and Maria's case, this was an important part of their story. They never had children and were deeply passionate about animal welfare and early childhood development. They gave regularly and generously, but they weren't doing it in a structured way.
From a tax perspective, that mattered. In South Africa, taxpayers can claim a deduction for bona fide donations made to a approved public benefit organization, or a PBO, provided that they receive a valid Section 18A tax certificate. However, there are two key limitations. The deduction is capped at 10% of the taxpayer's taxable income. Any excess donation can only be carried forward to the future tax years. Because Thabo and Maria were giving informally and inconsistently, they were often not fully utilizing the available tax benefit.
What we did instead was introduce a more intentional giving strategy. By ensuring that donations were made only to approved PBOs and properly timing donations in years where the tax benefit was maximized, and also keeping accurate Section 18A documentation, they were able to do the following: continue supporting the causes they cared about deeply and increase the tax efficiency of their donations, and align their generosity with their broader retirement and estate plan. Nothing about their values changed. Nothing about their generosity changed. What changed was the structure, and that this made all the difference. Step 6. Retirement annuity and preservation fund planning. So Cam, even after retirement, retirement annuities and preservation funds can still matter, not just for income purposes, but also for tax smoothing and estate efficiency.
Yes, and in Thabo and Maria's case, this became an important question. Thabo still had a pension preservation fund valued at 5 million, and Maria had a retirement annuity worth 3 million. Naturally, they wanted to know, should we convert these to living annuities now, even though we don't need the extra income? On the surface, converting might seem logical. But when we looked at it strategically, there were compelling reasons not to rush that decision. By keeping these funds unconverted for the time being, no compulsory income had to be withdrawn. No additional taxable income was triggered, and the investments could continue to grow tax-free within the retirement wrapper. So unless income is genuinely needed, converting too early can create unnecessary tax pressure and reduce future planning flexibility.
In Thabo and Maria's case, the optimal strategy was patience, allowing these retirement vehicles to remain intact, providing future income and flexibility, while enhancing long-term tax. Sometimes when it comes to retirement planning, the smartest move is not doing something too soon. Step 7 in this process is using the right tax wrappers and Section 10C disallowed contributions. The final piece of the puzzle is using the right investment wrappers and Section 10C disallowed contributions where appropriate. Depending on every client's unique circumstances, each of these tools can, when used correctly, provide massive tax benefits. They can meaningfully reduce your overall tax not only now, but also in the long run. In Thabo and Maria's case, these vehicles played a valuable supporting role in the broader strategy. So George, what is a tax wrapper and how can it be beneficial to certain clients, especially from a tax planning point of view?
Tax wrappers are investment vehicles such as endowments or sinking funds. They allow for tax to be paid within the structure or the vehicle, often at a lower effective tax rate. It also reduces your annual tax administration and reporting. Sinking funds or endowments can be particularly useful when marginal tax rates are high, since income is taxed at a flat rate of 30% inside a tax wrapper and capital gains at an effective rate of 12%. For Thabo and Maria, there was a significant benefit since both of their marginal tax rates were significantly higher than 30%, and the effective capital gains tax rates were also higher than 12%. There are, however, certain restrictions, especially when it comes to withdrawals in the first 5 years, that investors need to be aware of.
Section 10C disallowed contributions provides an additional layer of potential tax savings, especially for clients that have significant sort of discretionary portfolios and retirement savings. Although these contributions do not create an upfront tax deduction, they can potentially grow tax-free within the retirement fund and then later be used to reduce taxable income when benefits are taken and improve the overall tax efficiency of future withdrawals. We have done a dedicated video on how Section 10C disallowed contributions work. The link to this video can be found in the description below. Used correctly, these tools don't replace the core retirement strategy. They enhance it. They help smooth tax over time, improve flexibility, and reduce the risk of unpleasant tax surprises later in retirement. And when you step back and look at the full picture, this is the real lesson. Individually, each tool helps. Used together, they change everything. If this feels complex, that's because it is. Retirement tax planning isn't about one product or one trick. It's about coordination. And that's exactly where most retirees lose money. quietly year after year. If you'd like help reviewing your own retirement income strategy, you'll find a link in the description below to book a complimentary introductory call with one of our team members. Thanks for watching. My name is Hardi Swart.
And I'm Sondlo.
And I'm George King.
This is Family Wealth. Keep investing into your future.